You guys have probably all heard the term the velocity of money, which refers to the, let's say, frequency at which money changes hands in the economy, meaning deals getting done, houses being purchased and sold, transactions taking place, goods being bought and sold, basically money changing hands. And oftentimes you will associate a higher velocity of money in an economy with a healthier economy and one which is generating a higher GDP. So when we talk about the velocity of money, you when you ideally want to have a higher velocity of money, which associates itself with a healthier, more robust economy. In order to have a higher velocity of money, transactions have to be taking place. People have to be spending money in the economy. And oftentimes that will come in the form of someone buying a house and taking a mortgage in order to complete the purchase of that house. Most people in this country don't have sufficient funds to go out and buy a house for cash. Likewise, you will often have people take out credit cards so they can use that credit card to finance a purchase. Sometimes it's a purchase that is necessary. Sometimes it's a purchase that is purely just for recreation, right? Or of some kind of a, let's say, unnecessary item, a luxury good of some sort. But it doesn't matter. The point is that money and deals are getting done. Money is changing hands. I saw a story last night at the Zero Hedge that got me thinking about kind of where we're going. Where's the economy going? A lot of unknowns right now. People saying, "Well, look at this is recession has been or will be avoided." Many people who watch this channel already believe we're in a recession. Again, leave your comments and thoughts below. But that is, let's say, remains to be seen where we're going to be in 6 months or a year. But what doesn't remain to be seen is the fact that millions of people that have taken on student loan debt in this country are not only in default on their loans, they're late on their loans, but they are having a massive detrimental impact on their credit scores. And the reason why I tie this in today with the concept of velocity of money is because when you have a crummy credit score, when you have a FICO score, in the fives or sixes, you are not, for the most part, credit worthy, meaning banks will not extend you money to go and get a mortgage. Credit card companies will not offer you lines of credit, at least not without loan shark type interest rates. And usually the people that have lower credit scores, and I'm generalizing now, of course, there are going to be exceptions. Usually those people are less able to, let's say, conduct transactions, meaningful transactions in the economy and meaningfully contribute to the economy and hence the velocity of money, right? Let's say people that don't require credit, people that the vast minority of people in the United States are not walking around with rolls of $100 bills in their pocket, paying cash for everything, buying houses with cash, buying vehicles with cash, financing. I keep using the word financing, acquiring, purchasing, going on vacations, using cash for everything. Okay. That is usually not the case. By cash, I also mean someone who might use a credit card to get the points and then pay off that credit card each and every month, not running into debt, accumulating a balance on that credit card. So you understand what I'm talking about. That's not the majority of the consumers in this society. Right now, I just saw a statistic that the New York Fed Center for Macroeconomic Data quarterly report shows that overall household debt in this country rose by $167 billion, with credit card debt, it says, declining by $29 billion. I would venture, okay, I'll throw it out there, a wager and even a guess that the reason why credit card debt's declining is because people have maxed out, right? They're not able to keep increasing their credit limits and their debt because they're at their limit and there's no more there. They can't go back to the till for more credit lines. And so I would say, again, as a layperson observer, not an economist, that is likely contributing to that decline. But what we have in this country is a massive student loan debt problem. The debt in and of itself is, I guess it's only a problem or becomes a problem when the student loan borrowers are so straddled with debt that the income they're making from that job that they paid thousands of dollars for and tens of thousands, hundreds of thousands of dollars to go and get a college degree or a graduate degree is not now sufficient to cover the loan payments. Since COVID, a lot of student loan borrowers have been deferring and forbearing their loans. That's because the government said, hey, it's on us. You don't have to pay for a certain period of time. And then, at some point in time in the future, you can resume making those payments. So let me share this story with you because it is catastrophic, I believe, for a lot of young people. And it took me by surprise when I read it last night. And so I thought I would do a video on it today and share some thoughts with you all, because this contributes to a decline in the velocity of money in a society or around the country. When you have people straddled with debt, whether it's credit card debt, student loan debt, unable to make additional transactions, unable to get more credit, to buy a home, buy a car, et cetera, you have a declining economy, okay? And you have a declining velocity of money, hence an economy that's not going to proliferate. Okay, so let me share the story with you. The title of the story from Zero Hedge last night is entitled, "I Don't Know What to Do. Borrowers report credit score carnage as student loans hit reports." The reason why this is important is this. You need to have a decent or good or excellent credit score to be able to obtain credit in this country, right? A lot of people need to obtain credit, like I said a few minutes ago, to conduct transactions, to finance vacations, finance their vehicle purchases, finance their home purchases, finance their extravagant lifestyle that many probably can't afford to, let's say, maintain. And so what happens is they end up defaulting on these loans, including the student loans I'm about to discuss with you, and their credit score falls. And when these credit scores fall to the numbers I'm going to be sharing with you at where there's this many people in this country, there is going to be a fallout. There is going to be a price to pay for this, for the overall and broader economy. And again, I'd love to get your thoughts and your input on this. Last week we noted, it says, new report from New York Federal Reserve, which showed that while Americans' credit card debt is falling, okay, discussed that a second ago, credit scores are starting to decline due to an uptick in student loan delinquencies. Delinquency rate for student loans surged from below 1% to nearly 7% after pandemic era pause on student loan payments was lifted. It says, while the payments were resumed, the policymakers extended a one-year ramp-up period, okay, that shielded borrowers' missed payments from being reported to credit bureaus. This extension expired in October of last year, 2024, with delinquency starting to hit the first quarter of 2025. And here we go. Here is the data, and it is ugly. Needless to say, total carnage among borrowers, as one can see from Reddit's Student Loans Forum. And these are some actual borrowers that are giving their statements about what's happened to their credit score. My credit score dropped 240 points. I don't know what to do, said one Redditor, who said she can't pay her bills because she doesn't have a job after graduating in 2024. How many people do you know, whether it's you or a son or daughter or a loved one, that went through 4 years of school, racked up student loan debt, and can't find a job? I'd like to hear your thoughts. Next one, my score was in the high 700s and dropped to about 480, said another who said they were notified by reporting agency Experian that their credit took a massive hit. Guys, if you know anything about a perfect credit score is 850. Okay, anything I think below like 680. And again, you guys can look it up for yourselves. There's a scale that's excellent, good, poor, fair, poor, whatever. But anything under about 700, 680, you start to get in the danger zone. So this person said their credit score was in the high 700s, dropped to 480. I will tell you, with a 480 credit score, you will not be able to finance a cheeseburger. So, and look, this does not get, let's even say some of these are in error and they get taken care of. Most of them are not. They're just delinquencies, people not paying attention, people not honoring their obligations and repaying these loans on time. For those people, to take a credit score from 480 back to the high 700s, again, any of you that know this, it takes quite a long time. Okay, it does not happen overnight. And in the interim, what's going to be happening? Those people are not going to be out buying a home. They're not going to be out buying a new vehicle. They're not going to be out getting more credit cards and spending money in the economy, hence contributing to a decrease in the velocity of money. Next one, my TransUnion and Equifax scores took a 100-point hit due to my loans just being recognized this January, reported another borrower. My credit dropped from 720 to 550, said yet another who reported having 6 total loans from school that have been deferred for a while. Next one, credit got torched, reads a Friday Post. I'm unfortunately one of the 9 million people who received delinquency marks on my credit report from the Department of Education for student loans, which decreased my credit score by 118 points. One of the 9 million people who received delinquency marks on their credit scores. That's 9 million people who are going to be conducting less transactions in this economy, spending less money in the economy because most of them are spending money through financing and debt. Interestingly, it says several Redditors said their scores tanked from loans taken out in their names that they were unaware of, including a first example who said someone took out a bunch of fraudulent loans. Guys, I said, some of this is going to be fraud, some will be a mistake, but the vast majority of those 9 million are legitimate delinquencies and markdowns to the FICOs. So what's a good solution here? Pay attention to your credit score. Check your credit score from time to time. Make sure there's nothing on there that's not yours, okay? You can sign up with the American Express. All your credit card companies offer deals where they'll monitor your credit score and you can check it whenever you want. I think I have one through American Express. On my phone, anytime I want, I can hit that. It'll pull up my current FICO score. It'll tell me any delinquencies I have had, which I don't have any, but the point is if there was a fraudulent account taken out, it would notify me of something and I would be, let's say, warned to dig into it deeper. So a lot of this is just paying attention, okay? According to the New York Fed report, while over half of the newly delinquent borrowers already have subprime credit scores, okay, that makes sense. Behavioral patterns don't change. The fact that these students or kids or whatever were given loans, they already had some subprime credit scores. Maybe when they got the student loans, they didn't have subprime scores and they went on the irresponsible train. And then their credit score dropped, and now they're just following on, okay? And the bad habits continue to generate further bad habits. Around 2.4 million borrowers who entered delinquency this year had scores over 620, which could have allowed them to qualify for auto loans, here we go, mortgages and credit cards. Prior to delinquency being reported, let me state that again. Prior to delinquency being reported, 3.2 million borrowers whose scores were under 620, right? And that was 56.6% of the newly delinquent population saw their scores decline by an average of 74 points, right? So almost 57% of the newly delinquent population already had credit scores under 620. They're basically unbankable. They're unlendable, okay? And that was 3.2 million borrowers in this country. So they saw their credit scores drop by 74 points. That's going to put them in the mid 500s for a credit score. Again, I don't want to use the wrong word. It will come out very negative, but It's not good. It's not good. If you're in that space, that place, wake up, start doing what has to be done. I know a lot of people are going to say, I'll get the comments saying, well, we don't, that FICO system is, is a government based thing. It's rigged. It's this or that. We don't have to live within those rules. And the point of the matter is, you do if you want to exist in society. If you want to buy and sell real property, let's even say for an investment property, okay, you're going to at some point need to seek credit of some sort. Okay, and there's good credit and there's bad credit. Taking on a credit card obligation to go buy, a vacation you can't afford, or a car you can't afford, or a watch you can't afford. That's not good debt. But there are good kinds of debt that you can take on to better yourself, to increase your financial your investment portfolio. Those people are going to have no chance, and that's why I titled today's little thumbnail, they have no chance. And I say that respectfully. Maybe I should say they have no chance for several years, but those folks have got to get their you-know-what together now, okay? Because it will take several years to get those credit scores back to where you'll need them to be to qualify for any kind of reasonable financing if you're looking to buy a house, looking to buy a car, whatever it is. Another 2 million borrowers, it says, with scores between 620 and 719. And again, that's not a good credit score. That was 35.9% of new delinquencies. Saw their credit scores fall by an average of 140 points. So if you go from 620 to 480, you're screwed. If you go from 719 to 580, you're still screwed. Okay, so those folks, 35% of another 2 million borrowers are now going to have their scores between 480 and 520. All right, it's bye-bye to those folks for a while. All right, they better dig in, or I should say dig out of the you-know-what pile they got themselves into, and start to work on that. I've just been discussing credit scores and financial responsibility on this channel for a year and a half now, so it's nothing new. While there were another 400 borrowers whose scores were above 720, and that was only 7.2% of new delinquencies. Think about that. Smarter habits, smarter, just doing what needs to be done. Only 7.2% of new delinquencies had credit scores over 720. They understand the deal. And yes, it is a game. You got to play the game. They understand you've got to make those payments on time. Okay? So it's no surprise that the lowest percentage of new delinquencies had credit scores of 720 and above. But they saw their credit scores, it says, fall by over 100 points. So now they went from 720 to 620. Okay, they went from a bankable land, decent credit risk to, I don't want to say Loserville, but they're flirting with that line. 620, you'll get banks to extend you loans for cars at a 620 credit score. You'll probably be able to buy a house with 620, but you're going to be paying a higher rate of interest, and therefore you're paying more money over the life of that loan to repay that loan. All right. Over 1 million borrowers, it says, saw drops of at least 150 points. If you know how this goes with FICO scores, to increase your credit score by 150 points takes time. It takes diligence. It takes, not maintaining no debt. Okay, you have to have some revolving debt that you pay down. You have a track record developed of timely payments to increase those scores. But to get a credit score up 150 points is not going to happen overnight. Meanwhile, what are we going to have? We're going to have less velocity of money for these categories of people in the economy, okay? And these are the young people, right? These are the ones who are supposedly supposed to have these bright futures, coming out with 4-year degrees, law degrees, medical degrees, whatever it is. They're going to be supposedly buying homes, buying cars, starting a family, and now they're going to have credit scores in the tank. So, it says, additionally, in closing, millions of borrowers face steep declines in their credit standing, which will increase borrowing costs or seriously limit their access to credit, like mortgages and auto loans. Okay, well, I hadn't read this article before. I shared it with you guys in full. That's what I just said. It's going to limit access to credit. Hope that the topic was, at least, if not applicable to you or someone that you care about, at least something that's eye-opening, all right? Not good news. We need to fix the mindset in this country with regard to debt and people taking financial responsibility, making payments on time, working on credit scores, and doing all of those things that, from my perspective, are important. Thanks for watching this unusual Sunday post, but I thought it was important and just something that was on my mind. Okay, please like if you can for me. Like the video, helps the algorithms, and if you're not subscribed, hit that subscribe button. It's a it's a free way for you guys to support the channel, so we'll keep growing. All right, went along today. Thanks a lot. Have a great rest of your weekend, and I will be back to see and talk to you all this week.